Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, and this is number 94, part 3 of our little series here on buying an investment property, all about how much we're actually going to make from this property. There's our disclaimer: facts and figures, information only, this is not advice. Okay, our property effectively pays us rent, hopefully, and that money is our yield. This is how much money we're making from our investment. Now, of course, the rent that comes in is what we call our gross yield. So this is the amount of money that we're getting before we have to pay all the expenses to run the property. Now, generally speaking, the gross yield is expressed as a percentage of the property purchase price. So this is what we can expect to, what sort of money is our property really going to make us? So if we've got a $500,000 property and we're getting $450 a week rent, that's $23,400 a year, then our gross yield is the $23,400 divided by the $500,000 value of the property. And of course, if we convert that to a percentage by multiplying by 100, then yep, we effectively get this 4.7 as our gross yield. Historically, yeah, look, 5% has been fairly standard across the country. It certainly does vary, and I'll show you in the next slide how it can vary across the country. But in December 2023, the national gross rental yields were 4.3%. So probably a little bit under the longer term average perhaps, but that is indeed the highest they've been since November 2020, and they're up from 4% in December of 2022. So we've had a little bit of a surge there of late, but probably historically over the longer term, probably still a little bit down in comparison, meaning that the amount of money we're making from the rent isn't as good as it has been in the past. So here's a chart here of all the various different regions across Australia, and you can certainly see, a big difference there between, even places like Sydney compared to places like regional Western Australia, and that's a nice to get 7.3% as a gross yield. We're starting to make some good money on our investment. But of course, what are the risks of buying in regional Western Australia as far as getting people to come and live there? Everything pros and cons. If we can get it and we can actually have it rented out continuously, then yep, having a property in a regional area like that could indeed give us great yield. But of course, everything has a flip side. And of course, if we've got a place in regional Western Australia, for instance, giving us this good income, is it actually going up in value? So what's our capital growth? See, the reason we buy an investment property is, generally speaking, two purposes. We're looking for money to come in to pay for it, and hopefully a bit of extra. And we're also looking for the property to appreciate in value. So in some areas, you might indeed be getting a really good yield, getting a good rent, but the value of the property really hasn't gone up a lot at all. And vice versa, you may find in Sydney, where you're not really getting as much money coming in on a sort of weekly basis, but the value of the property might have been skyrocketing during a particular period of time there. So swings and roundabouts, and different regions can give us different results. And that was like I said in the previous session. I'm fairly keen, if you're going to look at property number 2, then perhaps diversifying to give you a bit of spread across the different regions there. Now, of course, our gross yield was our money that we're getting from our rent. Our net yield is what we're going to end up with, the amount of money we can actually spend after we pay for all the costs, in theory, of running this property. Now, of course, one of your major biggest expenses is going to be the mortgage repayments. So if you've borrowed money for your investment property, you could easily find yourself paying $30,000, $40,000 a year, whatever it may be, in our repayments. Now, if you're paying interest only, they could be substantially less, but we're up for at least some sort of mortgage prepayment. Unless, of course, I say you've bought this thing for cash. But of course, we need to subtract whatever that mortgage prepayment is from our gross yield. And that could vary as interest rates change and so forth. Now, of course, if we've got a property that's perhaps interstate, then normally we would look at getting a property manager to run it for us. A bit hard, maybe, to do it remotely. You may be able to do that. Normally, I like the idea of having a property manager to take away all the hassles. And a property manager would cost you 5 to 10% per annum of your total rent for the year. So that's a big chunk. 10% of your income just disappears. Remembering that these expenses are indeed tax deductible, so any expense running to run your property is a tax deduction. So that's a little bit reduced after we get the tax deduction on it. But still, we are losing 10% or up to 10% of our gross income by having a property manager. Of course, we've got things like rates and land taxes. Here in Canberra, land taxes can be exceedingly expensive, and it's certainly a hurdle we've got to get over for a rental property to make sure that we actually are indeed making money from our property by the time we pay a land tax. So you're paying a land tax if you rent the property out. And of course, rates have gone up, especially here in the ACT. So these can indeed, again, be a significant component of your expenses. Now, if you've bought a property that's in a unit or a townhouse perhaps even, or it's in anything where you are sharing the land, then normally you're up for some sort of body corporate or strata fees. And annually, they could easily be, $4,000 or $5,000 a year. And so, again, that's a significant component of what we're earning. So you can start to see that our gross yield is starting to come down by the time we pay our mortgages and our property manager and our rates and our body corporate. But it doesn't stop there, because we've got things like insurances. Now, you normally would have to insure, obviously, the property if you've got debt on it, and because it makes sense to insure it anyway. But you may have landlord insurance, which will cover you for damages and any sort of breaking of leases and that sort of stuff. So you get paid if there are problems. But like any insurance, there is a cost. And so this insurance is an expense. Yes, it's tax deductible, but it's still an expense eating into your money there. Maintenance and repairs. So we've got things break down, the hot water cylinder blows up, the carpet gets torn, the curtains catch fire, which is a friend of mine, the old tenant using a candle in the bedroom, and all of a sudden the curtains, like the whole place didn't go up. But all of these things are indeed repairs that need to be done and fixed up. And especially if it's remote, it's not the sort of thing you can just sort of jump on a plane perhaps to go and fix. It could be a case that you've got to get a builder or a carpenter or something to come into your property remotely and pay for that. Normally the property manager would organise all that for you, but again, costs and more costs there. Depending on the property, if it's a body corporate situation, some of these units and things don't have a separate water meter, so that the tenant isn't responsible for their own water. It's done as a whole complex. Could be part of your body corporate fees. Could be an extra cost. But be aware that in some situations, yes, you may indeed have to pay for some of the utilities, even though you're renting it out and your tenant is getting the benefit of it. Accountancy costs. So, we've got the situation that our taxes are certainly more complicated because we're going to be claiming these tax deductions, and therefore your accountant is going to turn around and charge you every year. So one by one, and of course there's probably, depending on your property, there may be other things there that we need to consider, but these are probably the main ones there. But every single one of these things, it could be even the cost of you going to have to visit your property to do inspections or whatever it may be. Yes, any cost is a tax deduction, and people get really excited by the fact they're getting a tax deduction. But the tax deduction is only at your marginal tax rate. You still basically got to pay the expense. Yes, you then get a tax deduction on it, but you're still losing money. Okay, so our net yield, what we're going to get going into our bank account, the money that we can actually spend, is our gross yield minus all of these expenses. And we'll, in the next upcoming series and so forth, we'll have a close look at this and what that actually means to our cash flow. But yeah, people sort of just focus on, oh, you beauty, I'm making 5% gross. But, well, actually, most people don't add the word gross. They just say, yeah, I'm making 5%. Are you really? So you need to sit down and work out what these costs indeed are. Happy to help you calculate, should you need to, and of course we'll continue on with this in a further session.